Welcome to the daily update, where I'll go over the action in the market for Wednesday, October 25th, and then we'll see how things look for Thursday, October 26th. We had a pretty significant down day. We're breaking back below the 200-day simple moving average. We're starting to break some support in the S&P. We'll be looking at other support areas, not only in the S&P, but in other indexes to see if we can finally see some kind of a bottom before we bounce. But if we break through those other support levels, things could even turn more negative. I have a few extra charts to show you today, so I want to get right into this. Right at the open, we did have a gap lower open, and we opened below the 200-day simple moving average. On Tuesday, we closed above the 200-day simple moving average. So this is acting kind of like a ping pong match, going above and below the 200-day moving average. When we can tell that we've kind of hit a bottom is when we hit a support level and then bounce up off of that, and then the whole environment starts to change. That's not what's happening right now. We also ended up going down to S1 at 42.25. Prices fell down to S2 at 42.02. So now we're battling with the 4,200 level, which we ended up losing in Wednesday's session. We did rebound back up to S1, and then we dropped back down below S2. We never made it down to S3. We were kind of dealing with that 4,200 level, and we ended up closing at the low below 4,200. That's more of a psychological level, but still, it's something that the financial media likes to report on, and people listen to that and they're, oh my gosh, and then you have to react to that. We were down 1.43% on above average volume. We are negative with our technicals, and it's about inflation, interest rates, growth concerns, and mainly what's going on in Israel. Some comments. We did close back below the 200-day simple moving average. There's still this buildup of what's going on in Israel, and that can have an influence not only on what's happening geopolitically, but on the dollar, on gold, on oil prices, and those types of things, which can eventually feed over into the S&P 500. Google was down, and they came out with this great report, but they didn't like it as much as they probably should have. So Google ended up being down. Microsoft came out with a good report. They ended up rising, but most of the market ended up following Google's price lower. Oil did go up a bit to 85.4. The micro caps, they're setting another new 52-week low. Here's our list getting a little longer again with the 20-period exponential moving average, and that's been on there for a few days. The Stochk RSI, the Williams percent R, the CCI 14 and 20, they were on the list, then they were off the list. Now they're back on the list, as well as our stochastics. Intermediate term, we still have the 50-period exponential moving average, the Arun. A new addition is the Sean trend meter. And then we have the bullish percent index for the S&P 500 falling below 30. And right now it's still continuing to fall. Long term, we have the 150-day moving average, and we're also starting to get extreme with the 200-day moving average study. And then this whole scenario that the economy is stronger than expected, the Fed will need to keep rates higher for longer, possibly raise rates, keeping an eye on the Chinese economy, keeping an eye on what's going on in Israel, watching oil prices, and then we're dealing with earnings season, and that can have a real impact on the market. The dollar was up and interest rates were also up, and this is kind of the scenario that we've been seeing lately. The 30 to the 5 and the 10 to the 5 are back to being normal, and I have charts to show you that, and I've been showing those pretty much over the last few days. I'm also including the 10 to the 2-year and a 10 to the 3-month chart, since I don't go over those as often. They are still inverted right now, but they're showing improvement. Sentiment is negative. We had been at 32. We ended up going down to 30. Our trend is still negative. The ADX is above its moving average. It's going up. It's above 20, so that's a strengthening trend. The red line is on top and advancing, so that's a negative trend. Our bias, I should have changed it over to negative. I just forgot to change that. And our momentum is negative as well. We did get the weekly MBA mortgage applications index. It was down 1% on the week. Last week, it was down 6.9%. New home sales were stronger than expected. They came in at 759,000. They had expected 683,000. Last time it was 676,000. Here's a chart of the mortgage applications where we were down quite a bit in the previous week. We were still down in the latest week, but not as much. Here are new home sales, which had been showing a nice little increase going throughout at least this latest reading here. They were starting to come back down, but then we saw a bounce back up. And then the median price for homes, when you take a 3-month average, this is continuing to drop because you're having people having to lower the prices that they're selling for their homes. People can't afford the higher mortgages because interest rates are going up. And this is why we're seeing prices really go down. We settled still under that 5% level, but at 4.95% for the 10-year yield, which is above the 4.02% yield. And I'm waiting to see if we hit 5% here. If we do that, I'm probably going to take this chart and just put it over into the weekly video because I'm just kind of saying the same thing day after day. Here's the intraday chart where we gapped lower down below the 200-day simple moving average, which was now calculated at 42.38. We came down below S1 immediately down to S2. Looked like, okay, maybe we'll find some support here. We bounced back up to S1. Nope, we weren't able to break through that. So then we came down back to S2, broke below S2, and then pretty much closed at the low for the session, slightly under the 4,200 level. We're seeing pretty much across the board weakness with growth and value. Both the red line and the blue line did decline on the intraday chart. This is another bit of concern that we're watching now. We're seeing some weakness when we look at the growth to value ratio for the S&P. It was down on the day. We're still in a longer term uptrend on our end of day chart, and we actually ticked up a little bit since it slightly outperformed value. But we want to see this really breaking out if things are going to turn more positive. We're also watching discretionary, which continues to show weakness after giving us a recent death cross. Staples has already been in a downtrend, but this ratio is really starting to go down, even though longer term it's still in an uptrend with the blue line above the red line. Here's the condition of our trend with the ADX above its moving average. That means it's getting stronger. It's above 20. That means it's a confirmed trend. The red line is on top and going up. That means it's a negative trend. And seeing pretty much that same thing in the short term. The ADX is above its moving average. The red line's on top and advancing. We're also keeping an eye on the VIX. Not really sure where we're at these days with all of this. Maybe we're in this little bounce back up phase right now. This is just an average from 1990 to 2022, and we're never going to follow it completely. We're looking at the overall trend of the VIX, and for right now, the VIX has been going back up. The Ulcer Index, which is another fear gauge, continues to go up, and it's above its moving average. We're back above 20 on a closing basis with the VIX looking at the line chart, and we actually closed above, well, we shot more above 20, and we closed a little bit off of the high on the bar chart. Volatility is starting to pick back up again with the down day. We're above the moving average with the line chart as well as the bar chart. The VIX to VVIX ratio continues to go up. That's negative. The VIX to VVIX 3-month average ratio, that's continuing to go up. I haven't shown this chart in a while. And the VIX to move ratio is also above an advancing moving average. That's just showing the volatility is really picking up when you compare stocks with bonds. Here's the one-day chart of the equity put call ratio. I've been downloading again a little bit later on, and this chart then seems to be updated. We saw a real big spike up with the one-day chart of the equity put call ratio. And so what's happened now is our 5-period is starting to turn back up, and that is negative. Longer term, we're continuing to go up, which is negative. We're seeing a bit of a tick up again with this fear gauge, and our other fear gauge is also showing an increase in fear as we're going down. The ratio between risk on and risk off is now in a pretty solid downtrend. It topped out in about August or so, and now this is pretty sustained going to the downside, which is showing weakness. The mass index, we're coming up to this blue line, but now we're starting to roll over a little bit. We're wondering, are we even going to get to this blue line? The idea is that when we go above the blue line and then roll over, come back down, and then cross below the red dash line, the market is thinking that it'll reverse whatever it was doing at that time. We did get another signal back in August that really didn't help us all that much. Our advanced decline line, we're showing weakness based on price and volume, and we're below the moving averages. We're seeing a real expansion of new lows and hardly any new highs right now. So our 5-period and our 10-period continue to go down. We're below zero with our advanced decline ratio, both with the blue line and the red line. That's negative. Accumulation distribution below a declining moving average. That's negative, and that's measuring what the smart money is doing. The Chaikin money flow, which had been showing some improvement, this is also another smart money indicator, is now starting to turn negative, and we're seeing the red line begin to roll over. We're well below the 200-day simple moving average now. We still haven't come down to this pivot level yet. We're wondering if that is some kind of a support level which will hold. On the bottom, we are above average with volume, and over the last period of time, we're seeing volume start to pick up. So there's a lot of participation now. Here's a rate of change going back just one day from Tuesday to Wednesday, showing that we may have gone down a little far, a little fast. Nothing other than to just say it was a pretty significant down day. And you can see here on the chart where we're closing below even the previous low, and that is making things look more negative. The Stochk RSI is now back looking extreme negative, as is the CCI 14, the CCI 20, and the Williams percent R is also extreme negative. These are our usual short-term indicator culprits that gyrate around a lot, and they can stay either extreme positive or negative for quite some time. We just want to be aware of this. We're turning back up just a little bit with our 20-period exponential moving average, but we're still looking extreme negative, rolling back over with the 50, and we continue to decline with the 200. The force index did decline and is not necessarily extreme. The short-term stochastics, extreme negative. Intermediate short-term, getting extreme negative. And now we're starting to really drop and get extreme negative with the long short-term stochastics. The boom indicator based on 20 periods. And what this does is this measures how far is price away from a moving average. The top part is a 20-period moving average. Then we have a 50-period moving average, and then a 200-day moving average. And when we get far away from that, price tends to act or go back to the moving average that acts like a magnet. And we're getting down a little far, a little fast with our 20-period. That's the short term. We are declining with the 50-period, and we're dropping below zero and declining with the 200. That's extreme negative on top, and then just looking more negative with the bottom two areas. The Erin indicator ticked back up just a little bit on Tuesday, is now looking more extreme negative after Wednesday. We're showing more weakness when we look at the cumulative NYSE advanced decline line. It's really starting to break down again. But when we look at the regular advanced decline line, yeah, we're negative, but we haven't quite come down. We'll see if this other area ends up providing support. We are negative with the Swenlin trading oscillator based on price and volume. The go-no-go system is deep purple, and that's negative. The TTM squeeze is now crossing below the midpoint and turning red. That's negative. The balance of power, it held up there for a few days, but now is crossing below the midpoint. That is negative. And we're starting to drop below with our highest high and lowest low values. The midpoint is going down, and we're pegged pretty much at the red line, and that is negative. We're dropping back below the 200-day simple moving average. The vortex has the red line on top and advancing, and the green line on bottom. That's declining. That is negative. The ease of movement, which was showing a little bit of improvement, has now dropped back below zero. That's negative. The bullish percent index continues to decline below 30. That's negative. So the summation index based on price and volume continue to decline. When we look at a broader measure, the NYSE summation index, we're declining based on price and volume. Now, one thing that's a little bit interesting here is we're breaking to a new low based on price where we haven't exceeded this recent low based on volume. Don't know if that's a real big deal or not, but that's a bit of a divergence that we're seeing. The Elder impulse system for the S&P remains negative, and we're starting to break below support. The RSI, based on 14 periods and 9 periods, continue to decline. They're both below 50 and not extreme. On-balance volume is below a declining moving average. That's negative. And here's another interesting thing where we're really starting to break down with the 200-day moving average study for the S&P, where we haven't quite broken down yet based on the 50-period moving average. This is a little bit of divergence, which you could take it as positive because the 50-period is holding up a little bit better, or you could take it more as negative because that's the longer-term moving averages are showing more weakness. And I've tried to extend some of these lines with our short-term fib chart where we're well below the 100% retracement level. Now we're starting to come down and wondering, are we going to hit this other 100% retracement level? That's at about the 41.21 area. Please keep in mind that I draw these lines on here, and every time I go to adjust them, it makes the numbers wildly different. Longer term with our fib lines, we're also coming down. We're not quite at the 50% level yet, which is at about 41.56. Also, I draw the lines on here. We did break down below this double fib line when we go back to our long-term chart. That's not a good thing. Are we going to keep going down below this and hit these other levels? That's still quite a ways below where we're at right now. We're still above this quadrant level, though. We haven't broken below it. We're only about 16 points above it right now. So any kind of a down move could easily break us through that. And the copy curve signal, it's now gone away. The buy signal is now pretty much turned into a sell signal. The Pring bottom fisher, though, it's like, hey, everything's wonderful. Go long, buy, buy, buy. Well, that's not a good signal these days. Momentum, we're showing the PMO declining, both based on price and volume. We're not extreme yet with this. With the PMOs that are rising, they are declining and not extreme negative. We're declining with the buy signals. We're also declining with the PMOs that are above zero and just barely above the extreme negative reading. This is a broader measure with the bullish percent index. We are declining and we're not down below 30 at least yet. The NASDAQ 100 bullish percent index is also starting to decline and not at a 30 reading yet. So on a short-term basis, our slope oscillator is negative. The MACD is negative. When we look at all of our oscillators, we're starting to roll over with the longer-term tricks and KST. We haven't quite crossed over negative with those at least yet. And we're well below the 200-day simple moving average. But when you look at this chart, we're not necessarily extreme. We're right on the border between the -2 and -3 negative standard deviation. So when we say this has gone extreme negative, is if we get down into the -3 standard deviation. Chaikin oscillator below zero and declining, negative. Money flow below 50, declining, negative. Ultimate oscillator below 50, declining, negative. Here's a new one, the Sean trend meter. Haven't seen this in a while. It's starting to go into the pink area, suggesting that we are getting extreme negative. That's more intermediate term. The parabolic SAR still has the dots on top. That is negative. And we're breaking below this parallel green trend line here that I drew and looked like, okay, maybe this was offering some support. We broke down through that now. Now we're going back down to this, possibly this other blue trend line support connecting these two lows. If we do come down here, we'll see if that level ends up holding. Our long-term moving average study, we're getting extreme negative with the 150 as well as the 200 period moving average study. But the daily special K chart, it's like, I'm not going to really move right now. This is a long-term oscillator, and so it's still trying to decide what it wants to do. Looking at Dow theory, we're seeing some real weakness here with the transports. Where we were down with the Dow, it actually held up better. The transports are just looking pretty weak right now, and we did see some improvement with the utilities. And you can see the red line is really going down a lot more than the black line, meaning that the transports are underperforming. We're also seeing that in the transports to S&P 500 ratio, where this is really going down. In a good positive environment, we want to see this ratio going up. And when we look at the correlation between the S&P and the transports, they're pretty strong, meaning they're going in the same general direction at the same time. When we look at the Dow to transports ratio, it's really shooting up, meaning that the Dow is outperforming transports. The Zohorchak method, after giving us a strong buy signal for much of 2023, it hasn't fallen any more yet, but it still continues to be off of a full-blown buy signal. The Staples to S&P 500 ratio, it's starting to go back up, and that's usually negative for the S&P. The S&P to utilities ratio is starting to go down, which is also negative for the S&P. The 10-day average of the S&P 500 highs minus the lows after getting extreme negative and showing some improvement, now we're starting to come back down. We're also looking more negative with our 19-day exponential moving average of the advanced decline ratio. We're dropping down based on price as well as volume. The microcaps are setting another 52-week low. The Heiken-Ashi chart is negative. The KEGI is negative. The Renko is negative. And the three-line break is negative. The equal weight is really underperforming the weighted S&P 500 index. And we're still seeing this ratio holding up. That means even though the mega caps have been getting hit, the rest of the market's been getting hit even more. So this ratio continues to go up. The Dow is still hanging on to support here. We came down to this pivot level, bounced up off of that, and we could be coming down to test that again. We're still looking more positive, but if we stay below this 200-day moving average, we could see a death cross for the Dow. We are negative with the elder impulse system for the diamonds. And this is other areas of support that we're starting to break through here with the NASDAQ 100. We do have this pivot level down here, but this was quite negative for the market. And the elder impulse system had been at neutral. Now it's switched back to negative. The NASDAQ 100 momentum oscillator that we look at does show that we are declining and below zero, suggesting negative momentum. We're coming back down to the 61.8% retracement level. We're just a little bit above it right now. And we closed at the low. Are we going to end up falling down below this? The NASDAQ also coming down to possibly its 200-day moving average. That's another area that we want to keep an eye on. We usually end up watching the NASDAQ 100. The NASDAQ is a broader index, but if we do come down and hit this and bounce up off of that, that could be rather significant. If we break below it, that's also pretty significant. The NASDAQ 100 has now fallen more below the 50% retracement level. And the S&P 500 just continues to be under a lot of pressure. Recent death cross and declining. Also, the Russell 2000 small cap index, we're starting to get extreme negative with the RSI, working off of a recent death cross. The momentum is negative. The elder impulse system for the small caps went from being neutral back to being negative. The mid caps, recent death cross coming down, possibly finding some support at this pivot level. And we remain negative with the mid cap trend based on the elder's impulse system. The FANG index, which had been hanging in there fairly well, we only got pretty much shot in Wednesday's session. We were down 3 1/3%. We're falling well below the 50-day moving average, even though we're still in a longer-term uptrend. We're also keeping an eye on this. This is a longer-term look at the FANG index, where we haven't really broken out below these other lows that we set, and we'll be watching to see if that ends up happening. And we're still a little bit further below the arithmetic scale trend line going back to 2009. Looking at growth versus value, where we did see the Qs underperforming the S&P, we're still seeing some weakness in discretionary, and that's a bit of a concern. We also turned down with large cap growth versus large cap value. So with the large caps, we're showing some weakness, some more weakness with the mid caps, and continued weakness with the small caps. We're continuing to decline with our 50-day exponential moving average of the new highs and new lows. This is going down because our indicator, which is the black line, we're starting to get kind of extreme here. This is a line that I put on here. We could go down more than this, but a lot of times this will mark some kind of an extreme reading, at least in and of itself. And the more we stay below zero, the more this red line continues to decline. Looking at the 50-period moving average study for the S&P, after getting extreme negative and showing some improvement, now we're starting to come right back down. The mid caps also are showing some real deterioration and have not become extreme negative yet. We're getting kind of close here with the small caps with their 50-day moving average study. And on a broad market basis, we're looking quite negative now. When we look at the new highs and new lows, take a 5-period moving average for the Amex, NASDAQ, and NYSE. This is continuing to fall. We still have some more room to go if we're going to see some kind of a washout bottom. The dollar continues to go up and is still in the 106 range. The financial sector remains below its 200-day simple moving average. We haven't quite crossed over yet. Just another day or so, and we're probably going to get a death cross here. We're also watching this other support level for the financial sector. Yields did go back up. They didn't get back up to the 5% level yet, but we ended up closing at the high, and that put pressure on stocks. Here's the 30 to the 5 yield curve, where it's still looking more normal. The 10 to the 5 is also looking normal. Here's the 10 to the 2, and this is what a lot of people pay attention to. We are still inverted, but you can see how this is starting to come back up. And then looking at the 10 to the 3 month, also it's still inverted, but starting to come back up. It hasn't crossed over to looking more normal yet. And then we're looking at the 10-year yield in the US, subtracting the 10-year German yield, coming up with a positive result, which is going higher as the dollar has also been going up, and the correlation between the two is quite strong. This is negative for stocks. Tom Bowley's research. We're in this negative part of October. Maybe we'll see some kind of a washout hitting support at some point before we hopefully might end up seeing some kind of a bounce going into the end of October, if that's what you hope for. So earnings, they're still coming out. We're going to get Amazon on Thursday. That's a pretty big player. The UAW strike is still continuing, but I understand there's a tentative agreement. The last headline that I looked at, that they made some progress with Ford. There is a new Speaker of the House. His name is Mike Johnson. Well, I don't know anything about him, but I do know about 6 people with that name. It's a very common name. So apparently now that situation has been dealt with, but we'll be learning more about this person as we go forward. Still looking at what's going on in Israel and wondering if that's going to continue to escalate. The technicals are negative, and we're below the long-term support with the S&P, which is its 200-day simple moving average. We will get weekly jobless claims, durable goods orders, and the big one is going to be the first report of GDP. We'll also get pending home sales, and then we're keeping an eye on all the different geopolitical events. Here's the updated calendar, where on Friday we will get PCE prices. That's the other big inflation report that we will be getting. Stock Traders Almanac statistics looking a little better than they were for Wednesday, where the Dow and the S&P, they're positive. The NASDAQ, it's positive too, but just neutral to positive. And then we'll be on the 19th trading day. You see, on the 18th day, we've historically seen some real weakness. Well, we sometimes can see a bounce on the 19th day. So it looks like we're in this weaker part of the green line with the S&P. Also with the Carson research, as we're going into a little bit more of a downward move here. With the NASDAQ, we're also declining, and with the S&P, we continue to decline. We tend to be up a little bit more than down, going back to 1950 for the S&P when you just take election years. And then Bitcoin is still kind of bouncing up a little bit, making a little bit of news. People who don't talk about it all that much are now talking about it. Here's the chart. We're back up into the 35 range. Actually, at the time I took this chart, we were in the 34.5 range, but we are seeing a bit of a breakout here, and that is what the seasonality was suggesting could happen. So our scenarios, we're going with the down one right now. Our technicals are negative, and we're back below the 200-day simple moving average. Not going with the up one and not going with the sideways trend. We are in a confirmed trend at this time. Our longer-term equity put-call ratio is continuing to go up. The risk-on posture is showing weakness. Our 5-period is back on this list now. It's going up. That's negative. On a momentum basis for the S&P and the NASDAQ, we are negative. And we're back below 30 with the bullish percent index for the S&P. The Vortex and the parabolic chart, they are both negative. The 50-day moving average study that we do is also negative. The Russell, the small caps, and the mid caps are working off of recent death crosses. Positive signs, we still don't really know where to put the daily special K chart. Pring bottom fisher is just kind of like, yeah, I'm out here. I'll just be all by myself. Small and mid cap growth continues to be positive. The financial sector, just another day or so, and that's probably going to be taken off this list because it's below its 200-day simple moving average. So our conclusion, we're negative. It's a confirmed trend, and we're below support. In the short term, we do have some extreme negative readings, but we are negative. We're also negative and below support in the intermediate term, and we're back to negative again because we're below the 200-day simple moving average with our long-term trend. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.